Hello students. In this video, we shall be starting your chapter Ratio Analysis. It's chapter number 4 in section B. Let's just briefly understand the meaning of an accounting ratio. Accounting ratio is basically an arithmetical expression of relationship between two accounting variables. Ratio is basically when I compare two quantities. Here I am comparing two accounting variables. Now, before starting the chapter, in your textbook, please go through all these concepts, which is expression of ratios. The ratios can be expressed in the pure form, percentage form, times, and fraction. In the pure form, the ratio, the denominator should always be 1. Whenever the ratio is expressed in such a form where the denominator is 1, it is called as a pure form. In a percentage, I multiply the ratio by 100 and give the answer in a percentage form. In times, the ratio is expressed in number of times. I will come to this detailed explanation when we come across such expressions. And in fraction, the ratio is expressed in fractions such as 4 upon 5, 3 upon 4. In other words, I reduce it till wherever possible and then I leave it in the fraction form. Now, in your syllabus, your basic types of classification of ratios. So you have to cover up all these ratios. So we have first type is liquidity ratios, solvency ratios, activity ratios, and profitability ratios. In today's class, I will be just covering the liquidity ratios, which has further got current ratio and quick ratio. They are very important ratios. So let's just come quickly to what is a current ratio. Current ratio is basically a relationship between the current assets and the liabilities. Current ratio is a relationship between current assets and current liabilities. Let's see the formula of the current ratio. So current ratio is equal to current assets upon current liabilities. Current ratio is always expressed in a pure form. I just explained what's a pure form where your denominator should always be 1. Now, current ratio, ideally, there is an ideal current ratio means any company having the ideal current ratio for any company is 2:1. Meaning, for every one current liability, they have double the amount of a company has double the amount of current assets to repay its current liabilities. This shows that the company is in a good situation. If a company has a current ratio of 2:1, means the company is in a good situation. It indicates for every liability, for every current liability, it has 2 times the current assets to repay that liability. If the ratio of a company is say 0.5 is to 1, it doesn't indicate a good current ratio. Means for every liability, the company doesn't have a current asset to repay its liability. So this is not a good ratio and this is a ideal ratio. Even a higher current ratio, say 4:1, is not a good ratio. It indicates the assets are lying idle. They have extra assets which they can be invested somewhere and generate more money. Now coming to our current assets, we know the definition of current assets. Current assets are those assets which can be converted into a money in less than a year. So our examples of current assets are our short-term investments, our trade receivables. So here in the textbook are your examples, your investments, your inventories. Remember to highlight this. You can't include your loose tools and stores and spares in current inventories. I'll be just coming to this part. We have our trade receivables and current assets. Current assets, trade receivables include our bills receivable and sundry debtors, less provision for doubtful debts. This is your RBD or RDD. Current assets also include cash and bank balances. short-term loans and advances, and other current assets. Other current assets meaning your prepaid expenses or outstanding incomes. They are your other current assets. Your current liabilities are your short-term borrowings, your trade payables, and other current liabilities and short-term provisions. In my last class with you all, I had given you all a list of formulae. Those formulas will help you all to determine these current ratios. In that, one of the formulae was working capital is equal to current assets minus current liabilities. Please keep these formulas ready in front of you when you all are solving the examples regarding these ratios. Another important things before starting the sums which you need to highlight is that in case of your inventories, remember I have highlighted these 2 points. If you're given provision for doubtful debts or RDD, please deduct it from your sundry debtors before calculating your trade receivables. Second thing, your loose tools and your spare parts should be not be included in your inventories. They should be excluded from the inventories. The reason being they are not held for converting into cash. You are never going to sell your loose tool and spare parts. They are going to be used by the firm itself. So they are never converted into cash. So you always subtract them from your inventories. If it's mentioned, your inventories include loose tools and spare parts, please subtract it from your inventories. And another important thing is your proposed dividend, which is not considered as a liability. Proposed dividend is not a liability until and unless the dividend is approved by the shareholders. So if they are given your proposed dividend, you are not supposed to take it as your current liabilities. Now let us see the first illustration. I'll be doing illustration 3 on page number 4.8. You can just see the question. You can take a screenshot of the question.